Hi and welcome to the Martin Bell Show. Hopefully you've been keeping well. And in the video today we're going to be reading from the Daily Mail online, and we're going to be talking about the money section of the newspaper, and it's going to be about why I have fallen back in love with my ISA. The prudent investor on how he's found a smarter home for his pension savings. So this is about Rishi Sunak has frozen the lifetime allowance on pensions at £1,078,900. Anything above this will eventually face a punitive, or a very large sum of 55% tax charge. Those who rely on the stock market for their pensions will be hit the hardest, and they will. The lifetime allowance has been considerably higher than that in the past as well. It has been at 1.8 million and it has been now slashed down to 1 million. So there is a potential that it could be cut again further, meaning there could be further tax implications if you go over the lifetime allowance. So this is the same why some people are going back to their ISA, because you can get the money out when you need to. So saying here, I have fallen in love with the ISA all over again. For years, my ISA was the poor relation in my investment portfolio, as I piled money into my pension to gain tax relief on my contributions. But punitive recent tax changes have taken the gloss off pensions for anyone who saves hard and invests successfully. And this is true. I am investing into my SIPP. I will do for a bit longer, because I'm not nowhere near the lifetime allowance yet. I've only got about £2,000 to £3,000 invested, so it'll be very unlikely for me to start having to pay tax on it, as I'm nowhere near the lifetime allowance anywhere near yet. So saying here, those who have built up a sizable pension could be stumbled into a tax trap, yet this could be sidestepped with the help of an ISA. Earlier this month, Rishi Sunak became the latest chancellor to target the frugal by freezing the lifetime allowance on pensions to the same amount to 2026. And what this means is with inflation as well, this hasn't been increased with inflation, so you are being taxed further in a way. So anything above this will eventually face a punitive of 55% tax charge. This charge is entirely unrelated to how much you contribute. It is purely by a vicious swipe at successful investors. Charges levied by most ferocious investment firms pale compared with Sunak's tax grab. Those who rely on the stock market for their pension will be hit the hardest, and they will, while those in salary-based pensions, such as politicians and civil servants, emerge relatively unscathed. What can we do? Well, there is no upper limit on the amount that we can be held in an ISA. This should make us look up at how investments are structured. There's a principle in investment called the risk premium. Basically, there's the idea that the more risk we take, the greater the potential returns we should be looking for. I have breached my pension lifetime limit, so the tax charge for that every £1,000 that I make into my pension, £550 will eventually go to in tax, and that is no good. So what is the point of taking risk if the upside is more than halved? Bearing this in mind, I'm doing a little juggling. Until recently, I kept some cash in both my SIPP, my self-invested personal pension, and an ISA, and roughly a balance of investments across them. But I'm gradually moving the focus of my ratio investments into my ISA, which now holds very little cash. My pension will lean more towards cash and stogier investments, where I expect a slower growth and probably more income based. So one example is a Scottish mortgage, which previously I owned exclusively in my pension and had bought more of last March. This is a lively investment trust holding quite a bit of tech, with Tesla as its largest holding. Its value had doubled over the year, and it seemed to wise to take some profit, so I sold about a quarter. At the start of last week, I decided to buy some back after heavy prices fell, having spotted it was trading on a tasty 11% discount, meaning the shares were worth 11% less than the assets it held. I bought it within my ISA instead. If it booms again, originally won't be sharing in the profits. I have also used cash in my ISA to buy a fund called Fidelity Asia Pacific Opportunities, based largely on my observations on how much better countries in this region seem to have dealt with the pandemic. So the ISA also holds Polar Capital Technology, JPM Emerging Markets, and LF Blue Whale Growth. All funds are ratio end of the spectrum. Ironically, these all have suffered small falls since the start of the year and having a fabulous 2020. So basically, if they do too well and you get too much capital growth, you will hit your lifetime allowance, and then you have to pay a hefty tax bill of 55%, which is insane. The main purchase in my SIPP over the past year was RIT Capital Partners Investments Trust. This is a wealth preservation trust set up used by the Rothschilds family. So far it has done rather than I hoped for, better than I hoped for, returning a very impressive 22% since I bought it in the autumn. I can't see myself ever becoming an ultra cautious investor, but both my age and my tax position make argument for me adopting a more cautious approach to my SIPP, and I will continue to move my investments in this direction. For those still able to invest, the SIPPs versus ISA tax situation raises an interesting questions. Without running you through long and tedious calculations, it is reasonable to say that after dealing with tax relief on contributions and tax lump sums, a higher rate taxpayer normally walks away with either £70 to £85 for every £60 invested in a pension, depending on their tax status in retirement. A basic taxpayer gets £85 for every £80 put in, but if the contributions mean you'll eventually bust the lifetime allowance, then a higher rate taxpayer could just get £45 for every £60 contributed. The 55% charge is taken off a lump sum immediately. If you take the excess as income, you lose 25% at once, leaving you with the 75% from every £100. You are then taxed at your top rate on the rest, leaving a higher rate taxpayer with £45. Against this, putting £100 into an ISA and taking the £100 out looks simply unsecure. And the lifetime ISA offering a top up of £1,000 for every £4,000. Maximum £4,000 annually. Contribution looks positively attractive. You say, what about the investment growth? Well, I have done some more sums which showed darkly how the tax charge becomes more punishing the more successful your investment. Assuming your money grows by 4% a year for 10 years, you would finish with £148 for every £100 you invest in an ISA. A higher rate taxpayer would just put £60 into a pension to build the £148 and then would receive £103 and £125 after tax. This is what normally makes a pension so attractive. But if they breach the lifetime allowance, they could receive just £66 from their pension. Increase the growth to 6% in the ISA investor takes £179 from £100, while the pension investor could still take as little as £80 from the £60 investment. There's an old saying that you shouldn't let the tax tail wag the investment dog, but when the tail creates such a huge distortion, it deserves serious attention. So I have read some of the comments section box below, and it's saying that Some are saying it's not realistic, most people won't hit the lifetime allowance, but if you do have a good enough job that pays a decent wage, and you make the right sacrifices in life, and not just blow it all every weekend, you will probably hit your lifetime allowance, especially as the snowball starts to roll as well. It is very possible to hit the lifetime allowance. So that's something I'm going to have to keep in mind more when I get nearer the lifetime allowance. I'm thinking of something I'm going to have to think about more when I get more like a couple of £100,000 invested. Then that's something I'm going to have to start to think about a bit more once the ball starts to really roll. But that's just something to bring to your mind, just to make you aware. So if you've enjoyed this video and you want to see more of this sort of content, then please feel free to subscribe to my YouTube channel. Clicking the bell notification button gets you notified when I next release a video. Hopefully you're having a good day, and I'll see you all soon.